Good afternoon, everyone, and welcome to the SIA Wealth True Tactical Advisor webinar for June of 2022. My name is Colin Cieszynski. I'm Chief Market Strategist with SIA Wealth Management. It's been quite a month in the markets and quite a week in the markets. It almost feels like a month, considering how many big swings and all the volatility we've had. But there is a way of working through this. I'm going to talk through in this presentation a lot of the reasons for the volatility that we're seeing and ways to manage it and what some of the outlook is for the markets moving forward. And so this month we're going back to our older format of the Market Insights Q&A. We've had a lot of questions from advisors this month in particular, so it seemed like a good opportunity to kind of work through some of the questions that people are having and being able to describe the markets this way. So the first question we've had a lot of is inflation and stocks. Essentially, we had seen earlier this month, some people were starting to speculate, well, maybe the Fed will just raise rates a couple more times and that's it. But what does that mean? And then, of course, we had quite a rude awakening on that from the Fed yesterday with their big increase. So the question we've had is, are central banks near the end or the beginning of the current tightening cycle? And that is been a lot of what's been driving the markets through June so far. People that thought it might be a short cycle, bunching it up, and then people really thinking that it's going to be a much longer cycle distribution and knocking the markets back down. So I put this slide here together up to, and this is up to and including this morning. It includes this morning's Bank of England rate hike and yesterday's Fed rate hike. So the Fed raised interest rates by 75 basis points to 1.75%. But and they talked a lot about getting back to neutrality. Well, here's the thing. Neutrality is, for a central bank, is the inflation rate and the benchmark rate are about the same. And the long-term target for central banks is 2% for both. That's been neutral. Right now, we're sitting 1.75% in the US, 1.5% in Canada, a little bit below the long-term neutral rate, except that the consumer price index is way above the neutral rate. The US last print was 8.6%. The last print for CPI for Canada was 6.8%. And even looking at the treasury yields gives us an idea of what the longer term expectations are for interest rates among investors. Well, the US and Canada are have now moved themselves up and are in and around 3.5%, while interest rates, benchmark rates, are at 1.5 to 1.75. When we looked yesterday, also when the Fed came out with their dot plot, they kind of suggested that the majority of Fed members think that their benchmark rate should be heading towards 3.5% by the end of this year. So that kind of lines you up again with the 10-year Treasury note yield. The catch is, and I think this is really, really important for this cycle, is that in the past you would see the Feds would jack up interest rates and the economy would slow and then rates would come right back down again. But to deal with an 8.6% inflation rate, getting to 3.5%, it probably isn't going to be enough. And some of the Fed members have even come out and said, look, we may have to get, they have to hope that inflation comes down a bit and that the yield stays and their interest rates stay above it so that they can actually slow things down and get inflation back under control. So that's the bottom line of that. And the biggest one was, in looking at the dot plot, was not just that they expect rates to go up to 3.5% by the end of this year. It's that they expect their benchmark rate to stay above 3% through all of 2023 and all of 2024 as well. So this isn't a quick run the rates up and run them back down. The Fed members think they're going to run rates up and then keep them there. And that's very, very different than what we've seen for the last number of cycles and what we've seen in the last 10 years. And that's just now starting to seep into the mentality of the market. And so the other thing we've seen, just out of interest, was interest rates are higher, and the countries that have been raising rates, like the US and Canada, for the most part, have seen that in their currency as well. The more dovish central banks, such as Europe, who are just now starting to raise rates next month, their currency is down 8.8%. Japan, the most dovish central bank out there, their currency is down 16.2%. And today, the Swiss National Bank, who are running a negative interest rate and have been, they raised rates, or They went from negative 0.75 to negative 0.25. So that's essentially a half a point hike as well. So all the central banks are kind of coming around this. They're starting to raise, they're starting to tighten, and the reality is for a lot of them, they're just getting started. And here's some of the examples that we've seen. The one I mentioned here, Fed Governor Chris Waller says he's prepared to take rates past neutral to fight inflation. Well, if the CPI is at 8.3%, what is neutral? So we should be asking ourselves that. But ECB takes a hawkish turn to start. They're going to go positive on interest rates. Biden gives Fed Chair Powell space to fight inflation. Bank of Canada open to larger rate hikes if needed. And the biggest thing, Powell started his press conference yesterday basically saying their number one priority is to fight inflation, period. And Market Strategist, we're just going to have to deal with that and deal with the fact that this is a major paradigm shift. We had 40 years of declining interest rates, declining inflation. We're now into a new cycle of rising interest rates, rising inflation, and how do we manage that? And so I just did a bit of a thought exercise a couple of weeks ago in terms of what would it actually take to get inflation down? And there's a number of strategies that could look at, but basically it's too much money chasing too few goods. Well, how do you get that back under control? Well, the one everybody talks about the most is, and historically has been the most obvious, is raise the cost of money to reduce demand for money, demand in the economy and everything. So raise interest rates. Well, they're doing that. Number two, reduce the supply of money, which has been called quantitative tightening. The States is starting that now. The Bank of Canada is starting that now. Powell certainly said that they're going to be aggressive in quantitative tightening as well. So they increased the supply of money when times were bad to get the economy moving, and now they're reeling it back in. And apparently their plan is to do that pretty aggressively. The third one is reduce the demand for goods and services or cause a recession. And that one cannot be ruled out. In fact, we've already had one negative quarter of growth in the United States, and recent economic data suggests that their growth may still be slowing. The fourth one is reduce the value of consumers' assets. There's the stocks and real estate bubbles, and how do you unwind those? Because certainly the quantitative stimulus that they had done back in 2020 in massively increasing the money supply, we saw a lot of that quickly found its way into the stock market and sparked the gigantic gains in the stock market, and eventually flowed through to helping support the economy as well. Well, now we're into the flip side of that. How do they've done a huge amount of stimulus. Now they need to reel that back in, and in a way, perhaps they need to reel back in stocks and the prices of stocks and real estate bubbles as well, without them bursting and causing widespread other damage. There can be a lot of we saw back in things like 2008 or 2000 that when a bubble bursts, it can create a whole other heap of problems. So how do you unravel or let the air out of the balloon without it exploding and causing widespread collateral damage? So there's a lot there, but there's a lot of different tools the Fed has, and just one or two of them may not be enough to get this situation back under control. We have to recognize that as advisors, and what are the implications of this for all of our investments across all the asset classes? Why does inflation matter for the stock market? Well, we did this chart here that I've updated. It's 102 years of inflation versus the stock market. And what this showed was, on average, years that had the CPI less than zero or deflationary, the stock market did fantastic. And no inflation, low inflation, stock market did great. Inflation starts to pick up 2%, 3%, 4%, average returns for the market kind of coming down. The inflection point zero was about 5%. 5% CPI, 0% return for the stock market. And then if you started going CPI above 5%, you started seeing larger declines for the stock market, down to around 4% on average. So high inflation tied to lesser returns in the stock market over the longer term. And this chart here is the 100-year chart of the US CPI. And this shows us that we really have broken out. It really has gone up, and it really has started to become a problem, because it's blasted through 5% for the first time in 30 plus years. We're now getting back up to levels last seen around 1980, so that's over 40 years. That's longer than most people's working careers. people now that are 65 and getting ready to retire entered the business around the time that inflation last peaked and was starting to come down around 1980-ish, late 70s, early 80s. So the people that are about to retire, this was the very beginning of their career. And for the majority of people in the markets, this has never happened, right? Anything before even 1990 for a lot of people might as well not even was somebody else's lifetime, right? So this is really important. This has changed. This whole inflation thing has changed, and the whole way of approaching investing and strategy and trading has changed. And that is really important until the central banks can get this under control. And the important thing about the dot plot was this may not be a fast process. This may not be the previous where they'd run rates up and bring them right back down again. It may take a number of months or years to get inflation fully back under control now that genie's been let out of the bottle. So now the next question, could interest rate hikes cause a recession? And for that matter, are the rate hikes today causing a recession? Well, we're certainly seeing a lot of signs of things slowing down. And so we had the target profit warning, a whole pile of US retailers put out profit warnings. We've got Netflix has had their subscriber growth slow for the first time, and they're having to restructure the whole way they're looking at doing business. Earlier this week, Coinbase and cryptos have crashed, and Coinbase is laying off 18% of their workforce. This was a little article I actually saw on CNBC just this morning with Jim Cramer last night, warning, even high quality, low price to earnings stocks could get beaten down by a recession. And that's really important. And I'm going to show some slides that speak to this a little later on in this presentation about different types of factors and strategies and how they've done in different types of economic conditions. Something else to look at here is central banks have been cutting their GDP projections. And so a couple of examples, the European Central Bank last week cut 3.7 to 2.8%. Yesterday, the Fed cut its 22 growth projection to 1.7% from 2.8, and back in March they had cut it to 2.8 from 4.0. So it's come down pretty substantially since December. They've cut it in half essentially since December. So quite a big drop off here in terms of GDP projections. Some of the other things we've seen, May US auto sales came really rolling down hard, and some of the automakers were showing some pretty substantial declines in their sales in May. A year ago, people were still getting stimulus checks and rates were low. Now the stimulus checks are gone and rates are rising, and that's costs of borrowing, costs of leasing are all starting to go up, and we're starting to see that bite into auto sales. This is the Atlanta. There's two the Fed things I look at. One is the St. Louis Fed and Fred and the U.S. money supply. I don't have that chart this month, but I brought this one along. The Atlanta Fed publishes a what they call GDP Now estimate, and a lot of investors, particularly in the States, use this as the current assessment of the U.S. Fed and really the government as to where the economy is at. And we can see by this green line over their forecast for this quarter has been deteriorating for about a month now as more and more economic data comes in. So we had the US had a negative first quarter. 2 quarters in a row are the technical definition of a recession. It looks like they're getting pretty close to it if they might not skirt it in. I mean, the other one is you could have several quarters of bouncing around zero, eventually could qualify as a recession too. So keep an eye out for that. This is Canada home sales. This was from the Canadian Real Estate Association. This just came out yesterday, in fact. And we can see that house prices had spiked through 2021. They had started to come down. They've still continued to come down even in the last couple of months. Housing sales in Canada have slowed dramatically as interest rates have started to climb up. So as I mentioned, factor strategies in bear markets, a lot of people ask us, well, is there anywhere to hide? What if I do dividend ETF or low vol or value, or will any of those strategies save me, right? And so I've done a bunch here. This is just for people to note. These are the ETFs I used for these various strategies. And the reason I picked these particular ones was based on longevity. I was trying to get as much data going as far back as possible. So I tried to use some large liquid ones that have been around for a long time that can give us enough price data to be able to analyze. And so this little table here tells us, I've looked at a couple of bear markets. I did the recessionary the bear markets that coincided with recessions in 07 and also in 2020. So and basically what we saw during those bear markets was that you had substantial declines for the index SPY. The dividend funds also showed substantial declines. The low vol was only around in 2020. It showed a pretty substantial decline. Value in both cases showed not only big declines, but actually bigger declines in the overall index. But what was important and interesting here was, though, that in both recessions, bonds went up because interest rates came down, and gold actually did extremely well in 07 to 09. In 2020, gold did pretty well through part of this, but then what happened was that another part, the US dollar took off, which knocked gold back down. So, but gold against other currencies actually also did well in the 2020 recession. I compare this with the expansionary bear of the bottom one, actually, of 2018, where you had a near miss on the bear market, but you did not have a recession. So this time around, dividend stocks did go down less than the market. Low vol did go down less than the market. Value was about the same. Bonds picked up and gold's picked up. So that was important. So they helped you, things like dividend, low vol, and things like that helped you if you had a bear market but not a recession. But if you did have a recession, then it didn't matter. They didn't help you at that point. The one thing that was notable this time was so looking at this year's market so far, we haven't had a recession yet. So dividends actually have outperformed. Low vol has outperformed. Value has outperformed. Gold has outperformed. But the big difference this time is bonds, TLT. Bonds down 20% through to about a week ago. And that is because this time around rates are climbing, not falling. And that is really important and really critical. And if we continue to see that that rates do continue to rise like the Fed has forecast, then that can continue to be problematic for bonds. So that's really important to remember. This time around, it is different, especially for stocks and especially for bonds. And so, and this is a bit of some thought and noodling that I did and thinking about this and going back to finance textbooks that we did at university and things like that, and just some general thoughts on it. Why do people invest based on dividends? Why do you have dividend aristocrats? Why is this important? And it's because consistently high and increasing dividend payments are highly valued by many investors. And of course, Eric, that's the income component of equity. And we go back to the dividend growth models and things like that. It's one of the things that underpins the value of stocks, is the potential for current and future dividends. Consistent and growing dividends are generally seen by investors as a sign of a strong, well-managed underlying company. Wonderful. And so I also had received the question of, and how this kind of started was, well, what about dividend strategies in an inflationary environment? And so the way I thought of it was, well, the potential for dividend increases could help you to provide protection against inflation, especially compared with fixed bond coupons. So in bonds, your coupon is fixed and that's what you're going to get. Whereas at least with dividends, they do have the potential to increase if the company makes money, if the company is able to put through price increases. So that's not a bad thing either. The issue, though, and the risk with dividends is, if the economy goes into recession, your dividends could get cut. And that sometimes is a function of management, but sometimes that's the government has been known to force dividend cuts on companies, particularly banks, off of stress tests and things like that, and related to bailouts. You also can have where commodity prices crash, and then that impacts the resource company's ability to pay dividends and things like that. So it's not even always a choice of management. Sometimes it's outright their hand is forced by outside factors or outside parties. And historically, when you've had a dividend cut, has been known to punish the stock price, because as I mentioned, it's one of the key components of valuation. But on top of that, you have the double negative impact of your stock price might go down and you lose the dividend income. So that's the one thing that investors need to be very careful with, when is dividends are wonderful if profits are growing and the company's strong, but they are vulnerable if things go the other way. And that's just something that is important and should be part of anyone's risk risk management analysis. So another one that I wanted to look at was market valuations, and we certainly picked up on this thing called the Buffett indicator, which is quite interesting to me. And people have asked, well, markets have come down already this year. Aren't stocks oversold? They're due for a bounce. Surely they'll come back by now. We hit the 20% trigger. Now it's time for a rebuild, whatever, right? And are they at least not, and even if they're not oversold, are they at least not overbought anymore or overvalued? And so this thing's called the Buffett indicator, and it's the ratio of the US stock market value to GDP. And this site, currentmarketvaluation.com, updates this every week or so. And it comes from a various number of sources that they've outlined here on this slide. And they show the historical trend line on this, and we can see that back in the 28, 29, we went below trend and kind of averaged out and unwinding the 2000 spike. And really since about 09, we've been above this trend line. And interestingly enough, in 2018 or 2020, we actually bounced right off of it. But what's interesting here is it's peaked up for the first time above 200%. It's just barely started to come back. We're nowhere near close to the historical trend line, which suggests on a valuation basis and on a fundamental basis that stock markets, even after this pullback, remain historically richly valued to historical conditions. And that's important for us to note here. So this may not necessarily be over, is the bottom line of from this chart. And I also get a lot of questions. We do a lot of work here on cycles as well. The presidential cycle, the annual cycle, the 10-year cycle, and a lot of work in seasonality, because it's important. And it's important for investors to recognize the reasons, the various reasons that drive the markets. And so some of them are related to fundamentals, and some are related to capital flow, and some are related to seasonality is another one as well. And capital flows are still the best way of showing how and where sentiment is changing. But even if some of the more immediate issues somehow manage to get clarified or resolved, the US midterm elections are in November, which could keep politics front and center throughout the year. And so the question is, how have US indices acted around previous US midterm elections? So this is a chart I've put together that shows the various monthly returns in midterm election years going back to 1970. And so I'll just highlight a couple of these ones here in terms of the colors. The greenish one is 1982. That was a bottom of a bear market and the beginning of a bull market. Also, 2002, the orange was the bottom of the bear market as well. 1994 was a light blue was a year the market struggled. 2018, I think most people here will remember that the struggles of the market around that particular midterm election as well. So just to highlight a couple here, in 1982, this was the end of a very long-term bear market. It actually, you can see, had the wide bar in August, and it actually picked up into August. But looking here, September was a rough month. So even generally, let's start with January's tended to be tough, February tough, March and April were a little better, weakening in May and June. July historically, on many seasonal levels of analysis, has generally been a positive month where you often have the spring correction, a bounce around earnings season, and then mid-August to mid-October have tended to be historically very rough months and rough times for the stock market. And if we look, say, for example, at the orange of 02 had a tough July and a really tough September. October tends to be a little bit more positive, but the reason for that is that oftentimes October is a split month. The first half of October is often terrible, but then you often bottom out mid-month and get a bounce such that the whole month doesn't look so bad. And then November, December doing a little bit better. So this is kind of the historical pattern and of markets in midterm years. And to be honest, it's not that much different from just a regular look at years as well. So we have had this rough stuff to start to the year. We did get a bounce in March. April was tough, May was kind of steady, and now June to date has been negative as well. So we've seen the markets have struggled quite a bit through the first half of this year. July and August historically a little better, and then September, October have been known to be fairly choppy and volatile. Another question we've had, and this was related more to asset classes, is the Canadian versus US equities. And despite oil prices being high and rising, the resource sensitive Canadian equities have been in the SIA Chart's asset class rankings fell recently, and actually are sitting below the more tech sensitive US equities, even though energy has for the most part outperformed tech for most of this year. And so what happened, and could this change at some point? And basically the answer is the rankings of Canadian equities and the various asset classes can be influenced by a number of factors besides stock prices. And for Canada, that's commodity price swings, but also currency changes. When we look at the asset classes, US versus Canadian versus international, that all ends up getting worked into a common currency, such that currency plays a role in the relative performance of things as well. And the US dollar has actually outperformed the Canadian dollar by a small amount, not as much as the US has gone up against everything else, but the Canadian dollar is still a little bit weaker relative to the US dollar this year. The SIA Chart's equity action call remains in the yellow zone, and on that, a number of asset classes are close to being tied to each other. But if there was to be any kind of a change, a large move for one or what have you, that starts to break some of these, that you could then lead to sudden significant changes in the rankings. So far, this is the case, but things are close enough in a lot of cases in our comparative analysis that, and this does happen sometimes, you can have things that sit very close for a while, and it's like winding like a spring, and then it pops or snaps, and then you have a whole bunch of changes at once. And you can see that in terms of the sometimes in the rankings within universes or between universes. So it's just something that we continue to keep an eye on at this point in time, but it's not completely unusual for something like this to happen. Just looking at the Canadian and US equities chart, we can see this is this goes up and down with the US equities. So US had a huge outperformance relative to Canada from about 2012 through to 2018, and they were kind of even through 2021. Now it's started to break down. This has started to shift back in favor of Canada. It hasn't been quick, but it has started to, this trend has started to turn. And we note here the last time Canada really outperformed, no surprise, was back in the 2000s and the early 2010s when the oil price was, well, up where it is now. So that's a significant thing with that. These kind of relationships take a long time to turn. The economy takes a long time to turn. Monetary policy takes a long time to turn. But then once these things get established in their new trends, they do tend to run for quite some time. So that's another thing for us to remember as well, whether we're looking at this, whether we're looking at economic forecasts, whether we're looking at monetary policy. And volatility is another question we've had. There's been 2 bear markets in the last 3 years. Is this an unusual amount of volatility? And so this was a chart I took of the monthly standard deviation for every single year going back to 1900. So that's 122 years. And then I grouped them by decade, and I took the average by decade, and I did this 2 ways, the return over month and the return over year. And what this chart showed us, and it was really interesting, and it really jumped out at me, was that it's not so much that things have become more volatile. What it is actually is that the 2010s were the least volatile, most complacent period for the stock market in the last 120 years. And we're starting to come back from that, and the mean is starting to reverse, and markets are getting more volatile. But it's not this huge mega volatile thing. It's just that they were incredibly stable and complacent, and we're just kind of bouncing back to normal. So the 2020s, I show an average monthly 4.38 is pretty much on the 120-year average. On the over year, we're still slightly below the 120-year average. So markets have become more volatile. They've been way more volatile than this in the past, is the bottom line with this. Is we're so far just coming out of a period of low volatility into average volatility. We haven't seen high volatility yet. And so we had another question here of, well, what kind of market cycle could unfold over the next 10 years based on this. Could you have a market that kind of slowly but surely churns its way higher, but with bigger swings, with greater and more frequent volatility? And has this type of pattern already started? Well, it was interesting because if you go back to 2018, and June of 2018, 4 years ago, we've now had 3 bear markets in the last 4 years. Even in the 2000s, there was 2 bear markets in a decade. So this has been quite a volatile market for major swings. And it shows just looking at the ETFs for a number of indices across the world. 2018, declines of 14 to 20%. 2020, declines of 25 to 35%. Year-to-date, declines of 11% for the TSX, and for everything else, 20 to 30% down this year. So this is the 3rd one in a row. So are we seeing more swings in the market, more large swings in the market? Absolutely, we are. And then this raises the question of, well, what does this do to buy and hold? If you've got these markets that are having these huge swings up and huge swings down, it's much more challenging. A challenging environment for investors, but it's challenging, but it also presents opportunities as well, because there is room within these big up and down cycles to take positions, to invest tactically, to not be passive and be at the mercy of the market or sitting in positions with no breaks or anything like that. There is room to manage risk. There is room to take advantage of opportunities when these kind of cycles present themselves. Which leads to another, the last of the main questions that we've had from investors, which is it too late for tactical? Is it too late for me to get involved, to make this change, to switch from passive to active, to start doing more? I missed the boat and I didn't sell earlier this year. The S&P is now in a bear market, down 20%. Do I just ride it out? 2 years ago, the market crashed. The Fed came in with the white hat in charge and helped save the market and drive it back up. And in 2018, the market crashed and Powell backed off from tightening then. And then the market took off again. Well, could that happen again this time? Well, from what it looks like and everything the Fed has said, maybe not. There's a reasonable chance that this time around the Fed might not be able to save the markets. And in some cases, maybe they don't even want to at this point. Maybe they need things to come back to earth a little bit because valuations had become so stretched. And how do we do this without causing potential larger problems? So it's a matter of now of, is the Fed going to come in with huge amounts of stimulus? Well, everything we've seen from the Fed's own comments to inflation to the economy says, well, maybe not. And in which case then it's not too late, because we're not at the end of this cycle. As I mentioned with the central banks, in a lot of cases, it's just getting started. In fact, in some ways, now is the time, because we could say, well, for the last 6 months, well, we've been in a correction. Well, the inflation is transitory and we're going to get a soft landing, but now it's become pretty clear and extremely clear in the last 2 days since yesterday's Fed decision that no, things are different. No, this isn't just a normal correction. No, this isn't like previous cycles. And now is the time to really be revisiting and saying, well, now is the time for tactic. Now is the time that, okay, well, we were able to make this assumption up to this point, but now it's clear that any assumptions from previous are likely not correct. And now's the time to course correct and do something now and take advantage of the chance to do this. So the answer to this is, it's not too late for defense. Investors, at some point in time, I've shown that there's been 3 bear markets in the last 4 years. There's also been 2 major recoveries. So, but to be able to participate in the recovery, you need to have capital. So it's still a need out there for investors to preserve capital if they want to participate in an eventual recovery, in an eventual upswing. And it's important to have a plan then to distinguish between some of the false rebounds we've seen in the last few months and something that's more sustainable. There's been no sign at all that central banks are even thinking about stepping in to help the market at this point. And as I showed from the Buffett indicator, overall market valuation remains high even after recent declines. So we have not gone into a recession yet, but if we do, dividends, asset prices, and other things could still be at risk, and that's important. So risks are still out there. So yeah, we've been hit pretty hard, but potentially we could go down more. And at some point, the market might turn around and there'd be opportunities again. But the important now is the time to it's not too late. Now is the time to be tactical. And this is a chart that I've actually used for about 15 years. And I think those of you that know me know that before I joined SIA, I spent 10 years working with day traders and people who like to trade with large amounts of leverage. And one of the most important things we would talk to them about is risk management, preserving capital, and making sure you don't get hit with big losses. And here's why. And I've used this chart for 15 years. You take a 10% loss to get back, the return you need to get back to break even is 11%. Okay, that's not so bad. You take a 20% loss, you need 25% return on your remaining capital break even. Okay, that's manageable. You take a 25% loss, becomes 33%. Return afterwards. You lose the 33% of your money, you got to make 50% on your remaining capital. And you lose half your money, you got to double that just to get back to where you were. It compounds, it gets worse. Right now, the S&P is at about that 20% loss. What happens if it becomes 25, 33? 33 is about where the NASDAQ is right now, right? What if we do end up down at 50? The longer that anybody waits, the harder it becomes to make your money back later. And that's especially critical with clients aging, with clients retiring, with clients needing their money. The preservation of capital is critical, either to pay out income or to have money around to be able to take advantage of opportunities when they do present themselves again. So it's really, really important. It's not too late. And it's certainly now is a time where it's becoming more clear in the markets that the situation is worse than people were. At the very least, the optimism of a quick turnaround is fading. I think everybody knew that the risks were out there for some time, but the idea that, well, this will be short, this will be quick, they'll be able to manage it fast like they have in the past, well, that's clearly going away. And I think that's becoming the wider recognition. So that's why this is important. And so this is a chart we've used in the past, and it's kind of tracks some of the bear markets and of the past, and how long did it take to actually recover your money. So this one looks at US bear markets here. And so we'll think back to the 2000s, and the Dow peaked in January of 2000, and it didn't get back above it again until October of 2006, 6 years, 9 months later, and the absolute decline was 37% to the trough. October 07 to 09, it was a 53% decline. You think I wasn't kidding on that last slide. Seriously though, you could see those kind of declines. And what does it take to get back? Well, eventually peak to trough to full recovery, 5 years and 5 months. And that was with a huge amount of help from the central banks. Let's not forget about that either. This one here, the February-March 2020, 1 month of decline and 9 months to recovery, that's the aberration. That's the one that's unusual. That was the massive, massive amounts of concerted help from the central banks. And even that, by the way, was peak to trough a 37% decline. As I mentioned, the S&P is at 20. Let's go back to some of the older ones. Let's go back to the 70s. November 68 to May of 70, a 30% decline in the market, 4 years to recovery. 76 to 1976 onward bear market, got back above it in 81. That was about 4 years. The 73, 74 granddaddy bear that some of us might remember the old people talking about when we were young, 23-month decline, 45% loss, peak surpassed November 1982, 9 years and 10 months. And of course, there's probably nobody really alive that remembers the Great Depression, but for what it's worth, that took 25 years to recover. Let's look at some other markets. The granddaddy bear of the NASDAQ, starting in March 2000, 78% decline. That was not surpassed until July 2016, 16 years and 4 months. Even within that, the 07-09 decline was 55% for the NASDAQ, took 4 years and 4 months to recover again, and that was with help from the central banks. The biggie, the Nikkei, peaked in January of 1990, has never come back anywhere close to that peak, 82% decline, never surpassed, 33 years, 4 months and counting. And the Nikkei within that decline was a more significant decline of 1996 to 09 to 2009, 152-month bear market, 66% decline, surpassed in October 2017, was 21 years and 4 months. Looking at this, the optimistic scenario was 4 to 6 years. for a recovery from a substantial bear market in most cases, but we can also see that it has the potential to be substantially larger as well. So no, it's not too late to get off the bus. No, it's not too late to start getting defensive. It's not too late. Now is actually the time that this realization is seeping in more and more in the markets, in the media, and it's time for tactical. It's time for true tactical. So, as I said, a lot of these questions that we've addressed in today's webinar are questions that have come to us from conversations with advisors such as yourselves. And so please feel free to contact us, send us any of your questions to sales@siawm.com. And as I note, we address the most frequently asked questions each month in our Market Insights. We will be returning to hold a webinar in July, and then we'll be taking a break for the month of August. So we will be back the third Thursday in July. These are the sales codes for the funds that SIA Wealth Management sub-advises for BMO Global Asset Management. And I'll just wrap up here, of course, with our disclaimers. So this concludes our webinar presentation today. Thank you all very, very much for joining us, and we look forward to talking again next month.